Here we go. What we're going to talk about today is investing in the digital age. And the very first thing I have to do is give you the standard SEC disclaimer, which is basically that everything I say here today is not an official statement of SEC policy. I can't give particular legal or business advice or investing advice. But hopefully we're going to learn some basic principles of smart investing and avoiding fraud, and introduce you to some resources that will be helpful as you go along your own investing journey and do the research that I hope you'll be inspired to do by the end of today's presentation. We're going to talk about the SEC generally. I think for those of you that might be interested in a career at the SEC, this will be some helpful information. I'll talk a little bit about the basics of credit, but not a great deal. It sounds like you have some other great resources to get that information. And you know, depending on the audience, many of you may know a lot of that information. We're really going to spend the bulk of the presentation talking about saving and investing and how to avoid fraud when you're making investing decisions. And then finally, as I said, SEC careers. Most of what I talk about today, you can find on our SEC website, investor.gov. We have two main websites, sec.gov and investor.gov. I'll walk you through both of them. But investor.gov is the website that is designed for the general public with general investing information. You can see what the landing page looks like there on the PowerPoint slide. All of these little boxes are drop-down menus that have a lot of really helpful information, including under additional resources. There are particular resources for students. Down in the bottom right-hand corner of the slide, you can see the box that says Get Help. So I want to make sure that you are aware of that. That is where you would submit tips or complaints if you think you've been approached by somebody who's less than scrupulous, or you have general questions that you want to ask the SEC. That's the best way to get that information to us. So when the presentation is done, hopefully you'll all take the time to go to this website and just kind of poke around. The website includes things like investor bulletins targeted specifically towards college students. So you can see what some of those are here on the slide, including a lot of information on crypto assets, which I will talk about midway through the presentation. So the SEC, as you may or may not know, is the exclusive federal regulator of the securities market in the United States. We have a three-pronged mission. You can see there on the slide. We have offices all across the country, 11 regional offices plus the main office in DC. The Los Angeles regional office covers all of Southern California, Arizona, Nevada, Hawaii, and the Pacific Islands. So a very large region, both geographically and in terms of population size. As was mentioned at the beginning of the presentation, I'm an attorney. I've worked at the SEC since 2003, so a long time now. I actually was not a securities lawyer before I came to the SEC, which may be relevant to those of you thinking about a career as well, kind of an indication that you can change the direction of your career. If you go one route and decide to go another way, there is an opportunity to make changes in your career. I was an intellectual property lawyer before this, which I actually enjoyed a great deal, but ultimately wanted to do something that served the public generally, and that's how I ended up at the SEC. I worked in the Division of Enforcement for a little more than a decade, investigating and prosecuting securities fraud. The SEC is a civil agency, so I get asked pretty frequently, why doesn't the SEC put XYZ bad guy in jail? And the short answer is because we can't. That is not within our jurisdictional powers. We do work very frequently with the criminal authorities. So the majority of the investigations that I worked on in the Division of Enforcement, there was a parallel criminal investigation, usually being run by the FBI or maybe the IRS or Postal Inspection Service or Homeland or some combination of these agencies and being prosecuted by the U.S. Attorney's Office. Our remedies, however, are pretty robust, even though we're a civil agency. The Division of Enforcement is able to go in and seize assets, seize control of entities that have been taken over by bad guys, bar the bad guys from working in the securities industry, get funds back to investors, get a receiver put in place over the entity, try to rustle up as many of the assets as we can, return them to harmed investors. We get repatriation orders from foreign countries, presuming we have good treaty relations with a foreign country. I've put in place border watches. So really a pretty robust arsenal of civil remedies. And I'll reiterate this when we get to the career part, but it's also a great place to work. For mid-sized federal government agencies, I believe this year we were ranked number 3 in all of the federal government agencies of mid-size, which is pretty great. Those results just came out. You can probably Google them and find them. One of the reasons that we are rated so highly, in addition to the very interesting and impactful work that we do, is probably that we are also on a different pay scale than a lot of the federal agencies, and we get paid more than most federal employees. So things to think about if you're thinking about a career at the SEC. The SEC has a lot of responsibilities. I've talked about the Division of Enforcement a little bit. I think that's the division that has the most profile in the press, investigating and prosecuting securities fraud. You can see there at the bottom of the slide that we have a pretty robust enforcement action. For the year that I have the most current data on, we brought almost 700 enforcement actions, collected close to $4 billion from those securities actions. We have a whistleblower program where whistleblowers who provide original, timely, credible information that leads us to a successful enforcement action can be compensated for bringing that information to our attention. But in addition to that, we do a lot of other things. We have rulemaking functions, like most federal agencies, where we enact rules to try to keep the markets as fair and orderly and efficient as possible. We review disclosures of public companies, and we examine broker-dealers and investment advisors and other market participants. And different segments of the agency perform these different functions. In the regional offices, such as Los Angeles, we have examiners and enforcement staff, almost always across all of the regional offices, I think, without exception. Some of the other divisions that don't have quite as many staff are not going to be staffed nationwide. So, for example, the Division of Corporation Finance, which is the division that reviews the disclosures of public companies, that division is really pretty much exclusively staffed out of DC. I'm going to give a small caveat there because even before the pandemic, the SEC did have work from home teleworking arrangements for some small portion of its staff. As you might imagine, that's been expanded quite a bit during the pandemic and most recently with the most recent collective bargaining agreement, because we do have a union at the SEC. So that means that there are some staff that are living in other parts of the country besides DC that might perform some of these other functions. And so you may have the odd person from, say, the Division of Corporation Finance in another regional office. But for the most part, all of the functions are going to be performed out of DC. Some of the functions will be performed out of the regional offices. The size of the market that we oversee is really quite large, as you can see there on the slide. The United States has the largest, most robust capital markets in the world, but we are just a mid-size agency with, I believe, roughly 4,400 employees, as I said, spread across 11 regional offices and DC. Again, there are some more statistics on the size of the market. As you can see, the markets that we oversee are in the trillions with a T. So quite large, quite robust, and really, frankly, the envy of the rest of the world. So that's the SEC kind of in a nutshell, and the markets that we regulate. Now let's talk a little bit about the basics of credit. And as I said, I'm going to go through this pretty quickly because I think we want to get to the main part of the presentation, which is investing. Really important to understand that there is an ideal credit-debit relationship. If you are just starting out as a young professional or a student just getting your first credit card, you may not fully understand, I think, the impact that credit can have in your life. I know I didn't when I was first in college. We hear that having a lot of debt is a bad thing, and that's not untrue. But kind of the paradox is you have to incur some debt in order to establish a credit score, and you need a good credit score in order to be able to get a loan for things such as a car or a house or what have you. So there really is an ideal relationship between credit and debit where you establish a credit record, but you pay that debt down responsibly according to the terms of whatever the agreement is. If it's a credit card, hopefully you pay it off every month, and that helps you develop and improve your score. So that's the ideal credit debit relationship, where you have just the amount of credit you need and you're using it responsibly. It's important to understand that credit is expensive. It's far more expensive to pay for something on credit than it is to pay for it in full. And there you see the example of a laptop, the difference between paying for it in full or paying for it with credit over the cost of 5 years, paying only $50 a month in payments. You can see the laptop becomes quite a bit more expensive, $850 more on the base price of $2,000 for the laptop. So credit is expensive and you should use it sparingly. These are some basic guidelines to help you improve your credit. A lot of them are probably things that you've heard: pay your bills on time, don't get close to your credit limit, and only apply for the credit that you need. So that's kind of the basics of credit. But now let's talk about saving and investing. And some people, if they're just starting on their journey, don't understand, I think, the difference between these two things. They sound like they're different, they're the same thing, but saving and investing are actually two different things. You want to start managing your money by setting a savings goal and putting together, hopefully, some kind of budget. And here's just basic information on putting together a budget, and set aside money for short-term expenses. That's saving. That's money that you earn, but you don't spend, potentially an emergency fund, something that you're saving up, short-term expense. But investing is more than. Investing is making the money that you earn but don't spend grow. So that's the difference between saving and investing, really focusing on making that money grow, probably for more long-term goals, such as retirement. Saving, you're typically going to put this money in some kind of low-risk product, like a savings account that's federally insured. And you generally, as I said, using it for those short-term goals, where investing is money that is going to be placed at risk. Why would you place your money at risk? You do that because of the possibility, and the key word is possibility or potential, for a greater return over time. Why can't you just put all your money in savings and avoid the risk? Well, the simple answer is inflation, which maybe seemed like sort of an imaginary concept a couple years ago when I gave these presentations, and inflation was quite low, but in the last year or so, probably has really been driven home to everyone that inflation is very real. And you can't just put your money under the mattress or even in something like a savings account that earns a very low 1 or 2% interest rate, because it's simply not going to keep up with inflation. If you put the funds in a savings account or under your mattress, for 50 years, hoping that they'll be sufficient to take care of you when you retire, they just won't, because the cost of everything will have increased. And this is why it's important to understand investing and participate in investing for your financial future. How does money grow? It grows through compound interest. And I hope everyone on the presentation is familiar with the concept of compound interest. Certainly this was something that was explained to me in college and high school, but I'm not sure that I fully understood the real beauty and seventh wonder of the world that compound interest is. That is essentially interest on your interest. So think of it like a snowball. You start out with a small snowball, roll it in the snow, it gains volume and size, it's able to stick even more snow onto the snowball. Think about that analogy applied to your money. You start with your small amount of investment that you make, it earns interest. That interest goes into the pot, and then not only your original investment, but your interest are earning interest. That's the beauty of compound interest. The longer that money is working for you, the greater chance it has to become that big snowball, because you've got more and more interest earning interest. We're going to talk about these categories of investments generally: stocks, bonds, and funds which might hold a combination of stocks and bonds. But let's talk a little bit more about how compound interest works. Here's hopefully a graph that's similar to things that you have already seen. Imagine that you are beginning your professional career and you start very responsibly investing $100 a month every month for your whole professional career of, we'll say, 40 years. and you put it in an investment that over the life of the investment earns an average of 7% annual return, which is pretty consistent with the average return of the US stock market. Since the beginning of the modern US stock market, circa 1920s, averaged over time, large cap US stock market has earned 7 to 9% annual return. Some years obviously more up, some more down, but that's the average return over time. So let's say this investment has been placed in that sort of, the funds have been placed in that sort of investment for 40 years. They've earned that return. You will have contributed at $100 a month over those 40 years, $48,000. But thanks to the power of compound interest, your account at the end of those 40 years is going to be much closer to $240,000 because your interest has earned interest. And you can see that reality reflected by the red line. And you can see that the red line really kind of picks up speed on the curve around about halfway through about 20 years of the 40-year investment journey. That's why time is so important. You need time to build up the interest on the interest to really get the full benefit of compound interest. And that's why everyone says investing early and consistently is so important to your journey. Can you expect to earn these very smooth 7 to 9% returns each and every year? Well, the short answer is no. On the screen, you'll see a representation of the S&P 500 over the last 30 years, and you can see pretty clearly there are some years that are quite significantly up and some years that are pretty significantly down, most notably the period covered by the recent recession. So in any given time period, your returns are not necessarily going to meet that average, but over time, you can expect, based on historical trends, that the US stock market has performed in that 7 to 9% range. And that's the goal that you're hoping for over time. Of course, no one has a crystal ball. No one can predict the future. But over time, if you're in for the long haul, you have the best chance of capturing that long-term return and being able to weather any downturns, which are, of course, inevitable. So here's another representation of that same information. If you had an investing goal, let's say of having a $500,000 retirement account by the age of 65, if you started investing early at age 25 and invested very consistently, you'd have to put in a lot smaller amount of your own money out of your pocket than if you waited until you were 55 to begin making that retirement account. Again, the retirement investing decision. Again, this is assuming a 7% rate of return. So at age 25, you're only having to put in roughly $200 a month in order to get that $500,000 because you are getting the interest on the interest. Whereas if you wait until you're 55, it's much higher, $3,000 a month. Best way to deal with this for most individuals is to set it and forget it. Have some sort of automatic savings and investing withdrawal that happens reliably every week, month, quarter, what have you, and just be very consistent with it over time. Within traditional investing classes, there are three main investment classes: cash, bonds, and stock. This is sort of traditionally major kinds of investments that individual investors think about. And what's important to understand here is that there is a correlation between risk and potential, the keyword being potential returns or rewards. Lower risk products have the potential for lower returns. Higher risk products have the potential for higher returns, but that is because they are risky. So for example, the category of cash covers things like not just cash, but cash-like products like CDs. Typically, something like a savings account that might be federally insured or very low risk, but is probably only going to pay a return of around a couple percentage points. Bonds, which tend to be riskier, have the potential for slightly higher returns, and then stocks, which are the riskiest traditional asset class of all, the potential for the highest return. It's important to understand this because you need to know what your own risk tolerance is when you set out on your investing decisions. So you know what combination of these investments or other investments might be appropriate for you. It's important to understand that risk and potential for return are always correlated in investments. So if somebody tells you, I have a very low risk investment, that pays really high returns, that's a huge red flag. That's not how investments work. Risk and returns are correlated. Hopefully, most of you have a sense of what a stock is. Just to delve into these categories a little bit more, a stock is basically an ownership stake in a company. The benefits of these is that the value of the company can go up, and therefore your share price will grow up, and the shares that you hold will become more valuable. Some of these stocks are going to pay dividends. Company might pay quarterly some percentage of the profits to the stockholders. You might be able to influence direction of the company in some small degree by voting your shares. But of course, the share price can go down, the companies can go bankrupt, and you can lose all of your investment funds. Those are the risks associated, or at least some of the risks associated with investing in stock. Bonds are like an IOU or a loan. Think of it like your car loan, but you're on the other side of the loan. You are financing the loan by investing in the bond and creating this predictable income stream that you get back to you, paid back to you by the government or the corporation that has issued the bond. That's like the interest payments coming to you, and then you get the return of the principal after the bond matures. But the bond's interest rate might not keep up with inflation. The company that issues the bond, if it's a corporate bond, could itself go bankrupt. So there are still risks associated with bonds, although they tend to be lower than stocks, they still exist. One category of stocks that I do want to talk about just really briefly are penny stocks. These are the lowest priced stock, and they are highly speculative. They're called penny stocks because they are usually traded at or under $1 a share. These stocks usually correspond to companies with little or no earnings. They might be dormant shell companies, and they're also companies that it's very easy for fraudsters to get control of. If any of you have seen the movie The Wolf of Wall Street, that movie portrays a real life person who was a broker who sold a lot of penny stocks, many of which were fraudulent, and he was engaged in participating in these market manipulation pump and dump schemes. So I'll give you an example of a pump and dump scheme that I worked on when I was in the Division of Enforcement. There was an individual running a company out of Seattle. This was, at this point, it has to be like 15 years ago. And what he said his company was doing was developing software to put in a bunch of electronic kiosks in airports all across the country where you could go up to the kiosk, punch in your gate, and then the kiosk would tell you the shortest path to your gate, the best restaurants along that path, what stores were there, etc. There's something like this, I think, in most airports now. But the reality was he had no technology, he didn't have any software, he didn't have any contracts with any airports. But that's not what the company was saying in its press releases. Then he issued another series of press releases talking about how the company had entered into some very elaborate, complex financing deal that was going to make the company a lot of money. Again, this was not true. The shares of this company were penny stocks, and so when he began issuing these press releases, they were trading under $1. But individual investors got very excited, started buying the stock, and the share price went up. I think ultimately, if I remember correctly, to somewhere around $3 or $4, which even at that low price, that's a really significant increase in the value of the stock price. What people did not know is that the CEO the company had issued him several $1 million worth of shares in the company at 0 cents a share. This is not uncommon for founders of companies to be issued a lot of shares in the company at low dollar amounts or $0 amount. But usually those shares are restricted and you can't trade them for several years, which is what everybody thought was the case with these shares. But in fact, he illegally had the restrictive legends removed. So when other people were buying, he was selling. And if you really looked behind the scenes at which shares were going where, mom and pop investors who are buying into this company are actually buying the shares that he's dumping into the market. And even if the shares only are $3 or $4 a share, if he's got 3 million shares and he got them all at $0, then he's making several $1 million. We prosecuted him because, as I say, ultimately these press releases were false and the price of the stock cratered, and the individual investors are left. And once they realized that the press releases began to suspect the press releases were false, they're left holding the bag. There really isn't much of a market for these penny stocks in the same way there is for something traded on the New York Stock Exchange. Penny stocks are not traded on the New York Stock Exchange. They're not traded on NASDAQ. They're quoted over the counter. You have to find a broker who's willing to trade in those stocks for you. And sometimes the market is really quite small. This is a pretty common scheme in this space because we're talking about small companies, maybe dormant shell companies. It's pretty easy for bad guys to get control of them and then engage in a manipulative scheme of the type that I've just described. So if this is an investing space that you are interested in, I would just encourage you to proceed with a great deal of caution and do a great deal of research before you invest. Because even if the dollar amounts seem low, even for legitimate companies, these are highly speculative companies with, as I say, very often little to no earning history. And in worst case scenario, they're fraudulent. So for a lot of individual investors, the kind of investment that may make sense for them is a mutual fund. Mutual funds are basically pools of money invested by an investment company in security. They could be just stocks or just bonds or some combination of those investments. And the benefit is that those mutual funds offer diversification, which is usually an investment goal. They're professionally managed. They're usually pretty affordable. And these are all things that usually individual investors are looking for. They are going to have risk, just like any other securities, and typically those risks are going to be the risks of the underlying securities that are held in the mutual funds. There are literally thousands of mutual funds out there, all different kinds, stocks, bonds, combinations, foreign stocks, domestic stocks. So there's more than one mutual fund out there that probably meets your own investing goals. Knowing that investments have risk, how can you manage investment risk? Two basic principles of managing investment risk are asset allocation and diversification, which really both come down to not putting all your eggs in one basket. What do these terms mean? Oh, sorry, the DC slide doesn't have the categories named properly on the pie graph, so I apologize for that. Asset allocation means dividing your investment portfolio amongst different asset categories. So looking at the pie chart, what you should see is stocks, bonds, and cash. So asset allocation would be putting some portion of your investment dollars in each of these categories. Which share should you assign to each category? Do you want more stocks, more bonds, more cash, more alternative investments? Knowing the answer to that question really involves knowing what your own risk tolerance is, which very frequently comes down to what your time horizon is. How long is it going to be until you intend to draw down on these investment funds? So if you're investing for your retirement, presumably that's quite a long way away if you're an undergraduate or a graduate student, and your risk tolerance is probably much higher than it might be for someone in my shoes who's closer to retirement. Think back to the chart that we saw of the S&P 500 and the ups and downs of the stock market. If I have a long time horizon and I know I'm going to be investing for 40 or so years, and the stock market takes a turn in the next year or two, I've still got 39 years to make up those losses and hopefully ride what has been the historical trend of an upward US stock market. If, however, I'm much closer to retirement, say 5 years out from retirement, I have less time to make up for losses. So I probably want to allocate my investments and my assets a little bit differently than somebody at the beginning of their investing career. Going from asset allocation to diversification within each class, more than likely for most investors, what they want to think about is not investing just in one segment of that type of asset, but in other segments. So for example, for the portion of your investment dollars that are going towards stock, you probably don't want to invest in just the tech sector or just the industrial sector, but you probably want to invest across a broad swath of companies that do a lot of different things, different parts of the market. Financial, technology, biotech, these are just some of the examples you can see on the screen. So within those asset pie wedges, you're going to divide that wedge down even further into different categories of the market. Why do you want to do that? That is to spread the risk. So what you see on the screen now is a snapshot of all the stocks tracked by the S&P 500 on a particular trading day. And I believe this trading day was sometime in January of 2022. Each of the acronyms corresponds to a ticker symbol. And if you look closely at this, you can see that we see different segments of the market represented. So in the top left-hand side, you'll see the technology sector, MSFT, that's the ticker symbol for Microsoft. Below that, you can see the financial and bank sectors, JPM, that's JP Morgan. All of the boxes that are red, that stock is having a losing day. All of the boxes that are green, that stock is having a winning day, and the value of that stock is going up. If the stock is box is sort of black or gray, then that stock is trending flat. If you were invested only in the technology sector, you probably wouldn't be very happy on this day and pretty concerned about your portfolio. If, however, you're invested more broadly, you've diversified your investment across the market, you're not nearly as worried because you can see that significant sectors of the market are still performing well. Industrials, real estate, financial. And that's the idea behind diversification, that you are spreading the risk among a lot of different categories and that hopefully overall the winners outweigh the losers, but at the very least, hopefully they balance each other out. Now, one way you could attempt to accomplish this diversification is to go out and individually buy each of these 500 stocks. That's pretty expensive because in addition to buying the stock itself, you're going to have commissions on the trading, time consuming. You probably want to do the research, which is pretty laborious and sometimes rather technical. So it's pretty involved. Another way to accomplish this diversification would be to invest in a mutual fund that tracks the S&P 500. The costs are going to be lower. You're not going to be paying those commissions on each stock transaction. It's going to be managed by a professional. It's going to be liquid. You're going to be able to buy and sell it on the market when you want to. And so for many individuals, this is why a mutual fund is a good investing decision. Let's talk a little bit more about rebalancing for allocation. Again, you can see this is another representation of it. If you have your investment portfolio and your retirement date is, let's say, 2050, that's a long way out. You might be more heavily balanced in riskier investments. Whereas if your retirement date is a lot closer, a couple of years from now, 2025, you might have a retirement portfolio that's more weighted towards more conservative investments like bonds. A particular kind of mutual fund that tries to accomplish this rebalancing for people is known as a target date or a life cycle fund. So when you have your first job, you may be lucky enough to have a job that has a 401k or similar type of retirement plan. And very often they offer these kinds of target date or life cycle funds that are balanced according to when your expected retirement year is. And those will get rebalanced as you approach your investment date. So for example, in the federal government, we have a 401k-like retirement program called the TSP. And we have life cycle funds like this that rebalance every 5 years. So if my retirement date were 2050, it would get rebalanced on 2025, 2030, slowly becoming more conservative as my retirement date approached. Now I want to talk a little bit about technology investing, since we see so much press about that in the last few years. If you're new to investing, I just want to encourage you to be really careful about where you get your investing advice. You may have seen recently, last month, the SEC brought a series of enforcement actions against celebrities who were touting investments on their social media feeds and not disclosing that they were being compensated for those endorsements. So hopefully it should go without saying that a celebrity does not necessarily make a good investment advisor and probably is not a good source of investing advice. Be really careful about information you get on social media. Even if you know the people who you're getting investing advice, I encourage you to do your own research. Their financial incentives and goals may not align with yours, and they, of course, may be the victim of misinformation just like you. Generally speaking, success for individual investors comes from playing the long game, not from engaging in get-rich-quick strategy. In particular, I'd be very cautious in the area of alternative investments, which are investments outside of those main three categories that I talked about and include things like crypto investments and hedge funds. That is not to say there are not legitimate investments in this category or that some investing in this area might not be appropriate for you given your own risk tolerance. It is just to say you should be careful because these tend to be far riskier investments than what we've already talked about. Some of them are very limited as to who can participate in them, such as hedge funds may be limited to only accredited investors, which has a technical legal definition. You can Google the term if you want to, but essentially what it means is really rich people who are able to take on a high degree of risk. These companies may provide far fewer disclosures than publicly traded companies do, so you may have a lot less information on which to base your investing decision. They might not be particularly liquid investments, meaning there might not be much of a market. It might be hard to buy and sell these investments, and they can be very complex and have really high fees. The SEC does have a crypto unit within its division of enforcement that has been pretty active for the last decade or so in investigating and prosecuting fraud in this part of the market, which I'm sorry to say is frequently a target of fraudsters. Essentially, I would say anytime there is something new, you're going to attract a lot of innovators, but you're also going to attract a lot of unscrupulous people who want to take advantage of the uncertainty and the lack of experience and knowledge in the market. We really don't know yet how this crypto market is going to shake out, so that makes it very speculative, even when it's legitimate. But it also attracts a lot of bad actors. So really be quite careful in this area. Make sure you understand it before you do any investing. Just by nature, as I say, it is speculative, and unfortunately, it does tend to attract a lot of bad actors. And what we frequently see is this is a space that not just unscrupulous people like the kind of market manipulator that I mentioned earlier get engaged in, claiming to have mining farms that don't really exist and instead are buying themselves nice cars and big houses. But it also attracts a lot of really, frankly, flat out criminals like international criminal cartels who launder their assets through crypto assets. So just be very careful in this space. Crypto assets are also highly volatile, which is, of course, an indicator of a pretty speculative asset. And so this is really an area you should proceed with caution in and make sure you're comfortable with the risk before you invest. You can lose all of your money when you invest, so you want to be very careful considering how much of your portfolio, if any, you dedicate to such risky assets. Likewise, with investing apps, just be cautious. They use a lot of the same sort of behavior sociology influencing techniques that social media does. And so sometimes they encourage participants in using investing apps to engage in behavior that isn't really in their best financial interest. It can be hard to get a hold of a real person. People get attracted, I think, to investing apps because they seem so cheap and possibly even free. But of course, the company running the app is making money somehow, and the way in which it makes money may not align with your own goals and incentives. So it probably behooves you to do some research to figure out how it is that they are actually making money. They should also be registered with us. So please check on investor.gov or the SEC website to make sure they are registered. So circling back to what we talked about mutual funds, this is why very often they do make sense for individual investors, because they provide this diversification and asset allocation, and they can really simplify your long-term investing strategy. Generally speaking, there are two types of mutual funds: actively managed funds and index funds. Actively managed funds are funds that try to outperform a market index. So they're trying to outperform that 7 to 9% average returns. Index funds are trying to match the performance of a specific market index. Having said that, I think the first thing most people think is, well, why don't I want to make more money? Why wouldn't I want the higher return? Obviously, we'd all like to make more money, but this isn't necessarily the way to make more money. because it really depends on the actively managed fund. It is quite difficult to consistently perform these market indices over time. Even if a fund outperforms for a few years, it's really hard to do that for 20, 30, 40 years. So understand it's really quite difficult. It's also expensive because there is more trading, more professionals involved in managing the fund. They are more expensive. Their fees tend to be quite a bit more than index fees. And so they have to make enough more over that index, not only to give you that additional return, but also to cover those additional fees. So even if they are to outperform the index, do they outperform it enough to cover those additional fees? And very frequently the answer is no. So it's really important to understand what the fees are that are charged by any fund you invest in, and take that into consideration when you're making your investing decision. This is why for a lot of individual investors, they are attracted to an index fund, mutual fund, as an investing option. To get a sense of how much fees can impact your returns, let's take a look at this slide, which shows 3 investors who've each invested $100,000 in the same investment product over 20 years, earning a pretty modest 4% annual return. But they've invested it through different funds, so they're paying different fees. Person paying the highest fee, represented by the green line, paying a 1% annual fee. Person paying mid-level is a 0.5%, and the person paying the lowest is a 0.25% annual fee. All those fees sound pretty low, and in fact, they are pretty low by industry standards. And the differences between them are pretty small, but they really add up over time. You can see that over the course of 20 years, assuming this 4% annual return, we've got pretty much a $30,000 difference between the person paying the highest fee and the person paying the lowest fee, even though we're only talking about 0.75 of a percentage point. $30,000 is a pretty big amount when you think of it in comparison to the $100,000 that's been invested. So those fees really do add up, and it's pretty important to understand what they are. How can you understand what they are? Well, your mutual fund is required to publish a prospectus, which you could get in a hard copy form, you could get online. But if you're doing research and you're thinking to yourself, I'd like to invest in a mutual fund, I've identified several mutual funds that I think might meet my investment goals based on what they hold in the mutual funds, but I'd like to run some comparisons. You can go to this fund analyzer tool at finra.org and put in the names of the funds or the ticker symbols and run a side-by-side comparison. Will give you a lot of useful information, including the fees charged by the funds. So I encourage you to take a look at this tool if this is something that you're interested in. Again, as you start your career, hopefully you'll be fortunate enough to be able to take advantage of something like a 401k plan. The screen just provides a little bit of information about the way 401k plans and similar plans and individual retirement accounts work. Essentially, you're able to make a maximum contribution up to a statutorily designated amount. Once you get to age 50 or above, you usually are able to make catch-up contribution in case you didn't begin investing early. And they usually have a choice of a lot of different investment options. Very often, employers offer matching contributions, which you should really try to take advantage of if at all possible. That's basically free money that you're leaving on the table. Usually you have to then contribute, let's say 2%, your employer will match that 2%, 3%, your employer will match 3%. That matching amount is money that you're just being given to invest in your employer-sponsored plan. So I really encourage you to take advantage of that. Generally speaking, the advice is kind of what you might think it would be. Start early. Take advantage of the opportunities that are provided by your employer, contribute consistently, and pay really close attention to fees. Hopefully those are things that we've all picked up at this point in the presentation. As I've said before, for most individuals, the way they get rich, or at least able to provide for their own retirement, is sort of slow and steady. The idea that most individuals who retire comfortably engaged in some sort of aggressive market timing super secret investment strategy is simply not the reality. What we see at the SEC is that people who are in a good position to retire have followed the core investing principles that we've talked about. They began early, they did their research, they made investments that were consistent with their risk tolerance, and they invested consistently over a long, long period of time. All right, tips to avoid fraud. The tips to avoid fraud are in many ways things that probably seem like common sense, but my own experience is that when even really well-educated, informed people face off across a really persuasive fraudster, it's easy to forget these kind of common sense tips. My experience taking depositions and testimony from fraudsters is that they are very, very persuasive, charming people, the life of the party, great people to have around, people who might be very trustworthy in other aspects of their life, the kind of person you wouldn't have any trouble babysitting, leaving them your kids for them to babysit, or trusting them to take care of your cat while you're out of town, but not trustworthy when it comes to money, and really use those very high-level social skills and intelligence for bad ends. So keep these things in mind. If it sounds too good to be true, it probably is. As I said at the very beginning, potential return and risk are correlated. There really is no such thing as the potential for a high return with little to no risk. Keep in mind what I said about the average of the US stock market over time is 7 to 9%. So if somebody's telling you something like 15, 20%, that's a very high return and therefore a very risky investment. Be wary of pressure to buy right now. How you're going to invest your retirement dollars or your long-term investing decisions are probably some of the biggest financial decisions you will ever make in your life. And anybody who's legitimate knows that and will want you to have the time to sit down and really look over the documentation and think about what's right for you. If there is no documentation, I would be very, very suspicious. The offer and sale of securities within the United States generally requires a fair amount of disclosure and filing and licensing or registration. So the securities offering should be registered with SEC. The salespeople or the people who are giving you investment advice for compensation should be licensed and registered. There should be pretty detailed information in these public filings about the securities. If those things don't exist, those are red flags, and I'll show you how to find that documentation. So if you give me a minute, I am going to stop sharing, and then I will share websites where we can walk through this. I think it's a little easier to understand as opposed to looking at the slide. So just give me a minute, and then I'll share. Okay, so this is where I would go to do the research on investment professional, either an individual or a firm, somebody who is buying or selling stocks on your behalf for compensation, like a commission. That's a broker, and they should be registered, or somebody who is giving investment advice for compensation, usually as a percentage of the assets they are managing. That's an investment advisor. They should be in this database. So if they're not in the database, that is a big red flag. If they are in the database, we want to look at their report that's in here. So I'm going to put in the name of a real person, Jordan Belfort, who was the individual featured in The Wolf of Wall Street that I mentioned before. And let's click on him and see what we can find out. You can see right here, he was a previously registered broker, not registered anymore. So that is something that we would want to take note of, because if he's buying or selling securities on your behalf for compensation, he should be registered. Let's click on this full report. Now, I would always click on this, and I would click all the way through to detailed report. This landing screen gives you a little bit of information, but you really want to get the detailed report. These reports are written in, hopefully, a manner that is accessible to, the goal is for it to be accessible to everyone, not overly technical. It starts out with a little bit of information about how the report is gathered, what databases and other sources are used to gather the information in the report. And it'll begin by just telling you a little bit about the registrant's background. What exams have they passed? It's an individual. Where were they employed in the past? Where did they act as a broker-dealer? So here we see Mr. Belfort pass the basic securities exams you would need to pass in order to be a broker. He worked at several different brokerage houses. But the really juicy stuff is at the end, which are these disclosures of regulatory events. Now, most individuals are going to have few, if any, regulatory events at the end of their report. I'm not saying if they do have things at the end, you shouldn't do business with them, but it's certainly something that I would want to take into consideration. If it's an entity, especially if it's a large entity, certainly there are going to be regulatory disclosures at the end, because any large company of any size is going to end up being sued at some point in time. And you really are going to want to read them to form your own opinion of whether or not they're significant. It's something you need to take into account. So let's say Mr. Belfort approached me today to do business with him. I go in, I look at this report. Let's see what I can learn about Mr. Belfort. He was sued by the state of Michigan. He was sued by the state of Maryland. And here's the really big one. He was sued by the SEC. And you can see if you read this, he was ordered to pay disgorgement of $1.5 million plus prejudgment interest of about $500,000 and a civil penalty of another $500,000. That's a lot of money for an individual, especially because we're talking about 1994, quite a while ago. Permanently enjoined by the SEC, so barred from the industry because he was operating a boiler room. So that's definitely something that I personally would want to know before I did business with Mr. Belfort. And this is why it's really important to research the individual. So let me go back to investor.gov. And just as I'm here, as I said, you can sort of poke around this website and see a lot of individual resources for students, teachers, some basic information on introduction to investing. Here's how you submit a tip or complaint to the SEC. Here are our most recent investor alerts and bulletins, which you can sign up to receive. And we even have some fun investing quizzes. So from here, I'm going to go to our other website, sec.gov. This is a lot more formal looking. I'm going to come back to this website when we talk about careers, because there's information about careers here. This really is written more to describe business of the agency and what it does. You can see the different divisions and offices, enforcement, but the part that we're interested in at this moment are filings. So your securities offering, as I said, should be registered with the SEC. If somebody is offering and selling securities in interstate commerce in the United States, more than likely their securities offering has to be registered with us. There are some exemptions, but they're pretty limited. So how am I going to search for that? I'm going to search in this, our Edgar database right here. Just to back up a little, if somebody is saying to you that their securities offering is covered by one of the exemptions and they don't have to be registered with the SEC, then at the very least, they should have filed what we call a Form D that describes which exemptions they're relying upon, gives some very basic information. How much money are they trying to raise in what kind of industry? And that form will be in this database. So even if they're telling you, we have an exemption, we don't have to be registered, you should still be able to find their name and their Form D in this database. But most of the time, they do have to be registered with us. So for example, if I wanted to invest in Exxon, very well-known public company, put it in, and here pops up Exxon. Very basic information about the company, where is it located, what business is it in, but the really good stuff is in the filing. And there are all kinds of filings in here, which I think sometimes is a little daunting. 8Ks, which correspond to press releases and may have interesting information like the departure of recent officers. But the things that people really focus on tend to be the 10Ks and the 10Qs, which are the quarterly and annual reports that contain, as you can see, a lot of pretty detailed information about the company. What are the risks that the company is facing? What's the basic business of the company? What properties does it own? What are the lawsuits that it's involved in? Who owns the stock? And then the financial condition of the company and the results of the operation. So pretty detailed information. Hard not to be a little overwhelmed by that, for sure. So if you're not familiar with looking at this information, I encourage you to go here to these guides on how to research public companies, which provides a lot of general information, including defining some of these terms like 10K and 10Q, and then more specific information on how to read a 10K or a 10Q in the financial statement. So this is where you need to go to get that information. So I'm going to stop this share and then go back to my PowerPoint very briefly so that we can jump over to the career portion of the presentation. Okay, so back to the PowerPoint. This basically provides the information that I just gave, just in the form of PowerPoint slides, which I think is less helpful. But you can see basically how it works. Finally, just one last caution: be really careful about how you pay. Legitimate brokers aren't going to ask you to pay with a credit card. If you are not familiar with the term advance fee scheme or advance fee fraud, I would Google that after the presentation. Scammers will often ask people to pay for things upfront with a credit card or an overseas wire. I would be very suspicious of that. It doesn't necessarily attach to an investment scheme. It might be attached to some kind of romance scheme. They'll ask literally thousands of people to pay, say, a $10 upfront fee to release a certain amount of money, or to help them get a certain amount of money out of some kind of account that they just need a few dollars help with, and then you'll get a percentage of that money. You'll pay that $5 or $10 or $50 fee, and you will never hear from them again. That's the scam, getting that fee out of you. So just be careful about paying upfront fees. I told you could report suspected investment fraud or contact us with questions on our websites, sec.gov or investor.gov. They both have a spot where you can submit a tip, complaint, or referral. Most of what we talked about today came from investor.gov. Lots of financial planning tools there, lots of investor alerts and bulletins, and then here's the basic contact information for the DC office. If you want to reach us, you can email us at losangeles@sec.gov. So I'll stop sharing so that I can let Mildred talk, and then I'll come back to talk about the career portion of the presentation.
Thanks so much, Carol. That was very informative. Thank you so much for going through that. Now I'm going to jump in and talk a little bit about internships, which it's one of the key things that you can do to best prepare yourself for a successful career and gainful employment. What we like to say at the Career Center, our mission is to connect all of our UCLA students with meaningful career opportunities. So in an internship, having an internship before you graduate is one of the best ways that you can secure that, so that you can invest and manage the money that you're making adequately, so that you will be able to enjoy it throughout your lifetime. Okay, so what I'm going to do, and just to tell you a little bit more about me, I know Beljani did a very nice intro. I do work at the Career Center. I work with employers. I interact with them pretty much on a daily basis. They tell me the opportunities they have available. They tell me what kind of students they're looking for. So I'm going to share a little bit about that with you to get you prepared for looking for an internship or a job. And with that, I'm going to drop a few links into the chat that are useful. And as we go through the presentation, I will start to explain them. Let me go ahead and share my screen. I just have a couple of slides ready for you. Okay, so internships, that is me. Feel free to reach out to me if you ever have questions. I lead the industry relations and experiential learning team at the UCLA Career Center, so I'm happy to be here. Okay, so let me tell you a little bit about internships. What can an internship do for you? There's this long list that we have put together, and this is only a snapshot of what they can do for you. First of all, research has shown that you will get twice as many job offers after graduation if you've had a paid internship during your time here at school. So it's definitely in your best interest to try and get an internship before graduating. The good thing is 90% of all internships are paid. There are still some very good quality internships out there that are unpaid. They're usually in the government or nonprofit industry. However, if they're unpaid, you want to do your research and make sure that they're a good quality internship, and the Career Center is here to help you out if you're not sure about your options. So make sure to come on and see us. So internships will also help you grow your skills in a professional setting. You'll get to interact with professionals, see what that being in an office culture is very beneficial when you start after you graduate from college, and just getting a feel for what is needed to be successful in a professional setting. You'll get a chance. One of the reasons is because you get a chance to apply a practical application of the knowledge you've learned in the classroom. You'll get to do that during an internship. You'll get to make connections with professionals. You'll get to explore different career paths. Maybe you'll do an internship and you think that that's what you really want to do, and then you end up not liking it. So that's why it's actually a good idea to try out different internships if at all possible. And if you really do like it and you do well in that internship, you might possibly even receive a job offer right after the internship. So you might not even need to look for jobs after you graduate if you get an internship and they give you a job offer right then and there. So those are some of the benefits of having an internship. Now I want to talk a little bit about something called career competencies. So an internship will help you be career ready. And one thing we do here at the Career Center, we work with the National Association of Colleges and Employers, and they are a huge association that does research and helps us help students find meaningful careers. But they surveyed employers and they asked them, what are you looking for when you hire either an intern or a new full-time employee straight out of college? And these are the 8 things that stood out the most. And I like to point these out because when you're putting together your resumes or when you're interviewing for a job, these are the things that you really should be focusing on talking about. Now, if you're applying for an internship, you want to think, and you've never had one before, you want to think about maybe part-time jobs that you've had where you've used these competencies, maybe student organizations where you did volunteer work. It may be a project that you turned in. And sometimes we don't think we've done this, but if you're at UCLA, you 100% have done all of these things at some point. One of the ones I'd like to point out, critical thinking and problem solving skills. Pretty much all of the classes you go through have you grow your critical thinking skills. Everything that they teach and the projects they assign, that's what they're all about. If you have teamwork, many classes do have teamwork. So that's another key career competency that employers look for. Leadership is another one. Professionalism and work ethic, oral and written communication skills. So these are all things that definitely make sure that you highlight in your resume and when you go on interviews. And if you have an internship, they will help you grow this, especially that I talked about being in a professional setting, professionalism and work ethic, learning how to manage your own career, learning a little bit more about how the professional world uses digital technology and global and intercultural fluency. So how is that used in a professional setting? Having an internship will help you grow these things. Okay, so that is a tidbit of the career competencies and how that will help you with your career. Okay, career resources. So I dropped the link to the UCLA Career Guide. That one's number 1 in the link. I definitely encourage you to open that up and go through it. So this is something that will take you some time, but it'll help you get prepared for your future career. It talks about those career competencies I just showed you. It also mentions how to fix up your resume, notes on how to have a really successful interview, how to network with employers at career fairs, how to explore what your interests are. So that's a great place to start. Another one is the UCLA Career Center website. Drop that link into the chat too. It's number 2. So make sure to go on there. We have so many resources. We have a career center here. We're happy to help you out, but we understand you don't always have time to come out and see us. So we have these resources available on our website that you can interact with 24/7. If it's the middle of the night, you get an urge to work on your career, we have resources for you. So one of the ones I really recommend is called VMock. That one will help you with your resume. It'll help you put your resume together, guide you through that. We also have mock interview tools. We have many different tools available. So make sure you spend some time checking that out. Number 3 is Handshake. If you haven't used it yet, make sure you're on there. That is where we post all of our jobs and our internships and events and things going on at the Career Center so that you can continue to grow your career. Again, you can use this completely on your own, but if you ever have questions with any of the things I've just mentioned, you can always feel free to come into the Career Center. And I'll tell you when we're open for drop-ins in a moment. Another thing I want to mention is career fairs. This is a really good way where you can interact with employers. We're actually having one tomorrow. It's a virtual career fair. If you haven't signed up yet, the link is number 4 in the chat. So you're able to go ahead as a student, you just click on that link, you sign up, and then you do need to sign up for either one-on-one sessions or group sessions. One-on-one, it would just be you and an employer. So you would need to make sure to come prepared, know who you're talking to, share a little bit about what you've done in college. Remember, talking about those career competencies is a good place to start. And if you're a senior, there are also jobs available. So make sure to check that out tomorrow. And go to the Career Center. So some of the things we have available. Where are we located? Many people have no idea where we're at. We're in the Strathmore building. This is a picture of the Strathmore building. It is very close to the School of Engineering. If you're at Ackerman and you walk south for about 5 minutes, you will get to our building. It is before the hospital, and just south of Ackerman. So go visit us. We're on the 2nd and 3rd floor. We have drop-ins available. We have something called Internship Lab every Monday from 10 a.m. to 2 p.m. Where you can drop in, you bring your laptop. The core thing you do when you're in Internship Lab is apply for internships, and we always have a couple of Career Center staff members available to answer your questions as you apply. And then we have drop-ins on Tuesday, Wednesday, and Thursday from 10 a.m. to 2 p.m. So you sign up to speak to a career peer or a career counselor. They talk with you for 15 minutes about whatever you have questions on. So you come ready with your questions. And these are both in person and virtual for the drop-ins. The Internship Lab is only in person. So we have something available for you to drop by the Career Center Monday, Tuesday, Wednesday, and Thursday. And connect with us on social media. You can follow us on Instagram. We post a lot on Instagram at UCLA Career Center. On YouTube, we have a few videos posted. And we also encourage you to follow us on Slack. So every day we post internship opportunities on Slack. If you join the UCLA campus community and then add the hashtag internship -opportunities channel, every day there's different internships posted, high quality internships. So those are different ways that I encourage you to connect with us, and I am available for any questions. I'll be available afterwards for any questions, but that is the core of my presentation. Oh, and I did also drop the SEC link if you want to follow them on Handshake. So in addition to the resources that Carol talked about, the websites. Thank you.
Great, thank you. Well, let me, if you don't mind, can I go back to the sharing my screen and showing you more about the career information at the SEC?
Yep, sounds good.
Okay, great. So let's go back to the internet and let's go back to the main sec.gov page. Again, as I said, here's where you can find drop-down information about careers at the SEC. Now, this is going to be just general information about SEC careers, what kind of careers at the SEC, people talking about their experience at the SEC, just generally speaking, what we do. The SEC does have paid internship programs. We have summer internship in DC and most of our regional offices. So we have a paid internship program in the Los Angeles office. New York has one, Boston, Chicago. The offices generally are spread all over the country. San Francisco, Los Angeles, Denver, Salt Lake, Atlanta, Fort Worth, Philadelphia, Chicago, Boston, New York, Miami, Atlanta. I think I covered everybody. Might be leaving somebody out, but pretty much all across the country, and most of them do have internship programs. We have internships for undergrads, and we have internship programs for law students and business students. We have internship programs running throughout the year as well. I'm not sure that those are all paid. So we do have a variety of different internship programs. As for permanent employment at the SEC, a lot of the positions at the SEC are either held by lawyers or accountants. So I think that is off-putting to some people because they think if I'm not a lawyer or I'm not an accountant, there's not a role for me at the SEC. And that is not true. Yes, a significant portion of our staff are one of those two things, but not everybody. We have an HR department like any significantly sized employer. We have people who do investor outreach like I'm doing here today. They are not necessarily lawyers. We have people who used to work in the securities industry and now work for us either as analysts or market specialists, or possibly they're economists doing work for us. We have computer tech people. So any kind of job that you can think of, press office people, support staff. I mean, there are all different kinds of jobs at the SEC. They're not just attorney or accountants. However, if you are thinking about a career in the law, and this is something that you might be interested in, it's really a pretty rewarding job. You get to go after the bad guys, which is pretty motivating. As I say, agency-wide, not just in the lawyer position, we work on a different pay scale, the SK scale, not the GS scale. So we do get compensated at a higher level than most federal government employees, and it's a pretty collaborative, cohesive place to work that really a lot of people are really proud to work at and really enjoy their careers at the SEC. If you are interested in working at the SEC or any other federal government agency, the very first place you need to go is usajobs.gov. Federal government jobs have to be posted through this website, USA Jobs. And in order to apply for a job, including an internship at the SEC or any other federal agency, you've got to have a profile on here. So you need to sign in, create an account, and create a profile uploading your resume. I'm sure your career services office has experience with this and can help you with it. But you can really go in here and search and see the jobs that are available at the SEC right now. So you can see here we have some people who are not lawyers who work at the SEC. Although, of course, as I say, there are several attorney type jobs. Lots of different kinds of jobs at the SEC, and actually we are pretty actively hiring right now for a variety of reasons. So I know there are a number of positions open all across the agency. I believe our summer internship, the application period has closed, and if those haven't been selected, they're probably concluding those interviews now because they usually start sometime in May. But probably if they haven't already posted, they'll be posting for the fall internship position soon. Right now we have 2 undergrad interns in the Los Angeles office, one from UC Irvine and one from UC Santa Barbara. And Irvine and Santa Barbara are not close to our offices in downtown Los Angeles. So as you can tell, we are very comfortable with people doing remote internships. I think both of those interns have come into the office maybe once or twice just to meet people and get a sense of what the office is like, but by and large, they perform their responsibilities remotely. If you are an intern at the SEC, the kinds of experiences we try to give you in the Los Angeles office are, if you're working with people in the Division of Enforcement, that you'll really be involved in the investigation. You'll get to sit in on some testimony. You'll get to meet with the attorneys as they plan the strategy on the investigation. Maybe you'll even get to meet with criminal authorities, be the kind of documents that we look at and the way we sort of try to piece together the puzzle and figure out the whodunit. If you were to work with examiners, you would hopefully get to go with them to broker-dealers or investment advisors as they examine their books and records and get a sense of what they do in those examinations to make sure those businesses are being run according to the regulations. We really try to include you as fully as we can so that it's as robust of an experience as it possibly can be for our interns. So that's some general information about working at the SEC. Do you have to be a citizen? That's a good question. And I think it depends on the job posting. Now, don't quote me on that. And you might want to call Maine SEC and ask to speak to somebody in the HR department. But really, you can probably get a sense of that by looking at the job postings. So each of these job postings on any job, not just the SEC. Government jobs on USA Jobs are going to have specific qualifications that are required for you to have the job. And so each job you're gonna want to go down and scroll through and really see what those job qualifications are. Here, this particular job as a statistician in our Division of Economics and Risk Analysis, I would definitely not be qualified for this job. I was an English major, so maybe also should be encouraging. You can work someplace like the SEC and have been an English major. Anyway, the duties of this job would involve, a fair bit of statistical analysis. For this job, you do have to be a U.S. citizen. And then it tells you a little bit more information about working at the SEC. As I say, I don't know this. I'm not on the hiring committee, so I don't know for sure. I imagine there are some jobs that you do have to be a U.S. citizen, but I suspect there are some jobs where you might not need to be a U.S. citizen. We have a fair number of contractors that work at the SEC too, not technically federal government employees. And those jobs, I suspect maybe the qualifications are a little different as well. But you know what? I will try to get a firm answer on that for you and follow up with the Career Center and let you know. I can tell you that having a diverse workforce is extremely important to the SEC. I go to a lot of meetings about how we can really do the best job we can to reach all segments of the population, both in our outreach and in our hiring. So it's really important to us that our staff is representative of everybody in this country. So I can tell you that that is really important to us, but I'll follow up on your specific question. Any other questions? Anything else in the chat?
So I don't see any questions in the chat. I'm just taking a look here. Okay. Nope, no questions unless you've got some in your personal chat. I don't see any here.
Let me stop sharing. It'll make it a little easier for me to see the chat. Yeah, I don't see any. If you have questions that you'd like to ask, but you don't feel comfortable asking in the larger environment, just email us at Los Angeles, all one word, losangeles@sec.gov. Mention that you attended this presentation. You can mention my name, Carol Lally, and we'll make sure that's my staff that reports to me, reads that email that comes into Los Angeles at sec.gov. So they'll let me know, and I'll try to get back to you with whatever information I can.
Amazing. Thank you. And I jotted down that email, so I'll be following up to everyone that attended and sharing that with them as well.
Great.
Awesome. Wow. Thank you so much. I
you.
thoroughly enjoyed both presentations. Great content on investing, fraud prevention, super important. Definitely not talked about enough, I feel like. Thank you all who stuck around. We do have an evaluation link that we would highly appreciate for you all to fill out a survey. This helps us improve as a service here at UCLA. Please complete that at your discretion. Yes, Arnold, it was super insightful and yeah, thoroughly enjoyed it as well. Awesome. Well, thank you all so much.